India was the 10th largest economy in the world. Today, India is the 5th largest economy. And India will be the 3rd largest economy soon.
In the mid-1980s, India was a top 10 global economy, but it tumbled out of that list for more than 2 decades as several countries powered ahead of it, particularly China. But India has been growing fast. As of 2022, it ranked in the top 5 for the first time ever. It is widely projected that it will be behind only China and the USA by 2030.
Hello everyone. Today on our channel, we have come up with a very interesting and very important topic, which is how the Indian economy works. So being an Indian, it's vital and utmost important that you understand in depth about how our economy works. I am pretty sure that I have broken it down in the simplest ever possible way so that everyone watching this will have a complete understanding of our economy and how the complete economic machine works. It's even important for you as an investor to know this, as the micro and macro economic fundamentals of the economy highly impact our portfolio stability, its growth and ultimate returns. Now, without wasting much of your time, let's directly get into the topic. I will analyze the economy of India just like analyzing a company. So if you see, every company has a single most target of running the business ultimately to make profit. To make those profits, you require capital. Also, to set up the business unit and further expand the business, you need to further have more capital. If you don't have it, then you have to borrow it. So microeconomics study the individual consumers and businesses in the economy, and the macroeconomics is the study of the economy as a whole, including issues like inflation, unemployment and economic growth. So we will be discussing in detail on all of this in this video. So if you see, Indian government runs the economy. Let's consider the Indian economy as the business. Now the revenue for the government is from the taxes and other non-tax revenues they get. Expenditure will stimulate the economy and increase productivity and also create employment. Employment rate is the percentage of the labor force that is unemployed and actively seeking employment. It's a key indicator of labor market health. So government has to bring in various policies and laws in place to ensure that the employment is in place and the unemployment rate doesn't increase, so that the economy is strong. So basically, the revenue breakup for the government, so especially for the Indian government, you can see on my screen, the income includes that of corporation tax, income tax, customs duty, union excise duties, the GST, which is again 16% of it, major chunk, then non-tax revenues and non-debt capital. Along with that, you have got the borrowings and other liabilities, which is like the government invests in bonds, treasury bills, PF, etc. So the returns of that as well is considered as an income, that is the revenue for the government. Also, government gets income from sale of assets like de-investment of various PSUs and also the dividends which is paid by this holding company PSUs. So as I told above, to have enough revenue, Indian government need to spend enough, which are called expenditure. There are two kinds of expenditure: revenue expenditure and capital expenditure. So revenue expenditure is basically the operating expenditure, and capital expenditure, as the name indicates, it's the capex. Now if the expenditure requirement is more to increase the revenue ahead and lift up the economy, and if the revenue is not enough to spend for the expenditure, then we have a deficit. So to bridge the deficit, government borrows from public and institutions. So this institution can be inside India or foreign institutions as well, which are located in various countries like US, China, etc. So that's a debt. So revenue minus expenditure gives you a fiscal balance, which can be a fiscal deficit or a fiscal surplus. Normally, it's always a fiscal deficit for a country, including that of India, where revenue always falls short of the spending. You should note that the deficit is paid back by utilizing the forex reserve of the country. So it's like a circular flow of income, a model that shows how money moves through the economy between households, businesses, and the government. It illustrates the balance between income and expenditure in the economy. So the total value of whatever goods and services the Indian population produces in a year is called its gross domestic product, GDP. So I am talking in the context of India, so that is why I am taking the name of India. So any country's goods and services produced per year is a GDP. So GDP is a primary indicator of country's economic performance. The more the GDP, the more the fiscal prudence of the country, as it generates more revenue and less borrowing. But if you see GDP per capita, which is the ratio of total GDP of the country to its population, is very vital to analyze the economic prosperity of the country. Countries like India has got very low GDP per capita compared to our developed countries like US. So another terminology here is GNP, Gross National Product. So unlike GDP, GNP is the total value of all goods and services produced by a country's resident, which can be both domestic and abroad. So if an Indian is working abroad and he is sending the money into India as remittance, so the total value of goods and services even produced by a foreigner Indian is also accounted in the GNP. So GNP is always greater than GDP and will give more idea about the total contribution by the Indian population to the overall goods and services produced worldwide. Just like in businesses, more profit is generated when you export more goods and services rather than imports. The difference between the country's export and imports are called the balance of trade or simply trade balance. So it can be a trade deficit, it's like imports are more than the exports, or it can be a trade surplus where the imports are less than the exports. So trade surplus is always considered as a fiscal prudence because the consumption is less but the export is more and more foreign currency is coming into the country. Now let's talk about current account balance of a country. So current account balance is a key indicator in international economics that reflects the difference between a nation's savings and its investment. It shows whether a country is a net lender or a borrower to the rest of the world. People often confuse current account balance with balance of trade. If you see, current account includes trade balance, that is balance of trade, plus net income plus net transfers. So trade balance already we discussed above. Net income, also called the primary income, includes earnings on foreign investments like dividends and interest and wages paid to the foreign workers. And if you see, net transfers, which is also called secondary income, includes remittances from abroad, foreign aid and other transfers of money that do not involve a goods or service in return. So that's like trade balance, net income and net transfers, which are all part of current account. So a current account balance can be a current account surplus or a current account deficit. So a current account surplus occurs when a country's export of goods, services, income and transfers exceeds its imports. This indicates that the country is a net lender to the rest of the world. Now comes current account deficit. A deficit in turn occurs when a country imports more goods and services, income and transfers than its exports. So if you see, it's kind of weird that the remittances from the foreign Indian workers, which is like the money transferred to India from the foreign countries by the Indian workers, is taken as part of current account deficit. So current account deficit suggests that the country is a net borrower from the rest of the world, unlike the current account surplus. Current account deficit is an important indicator of a country's economic health. A persistent deficit might indicate that a country is over-reliant on foreign capital, while a persistent surplus could indicate strong competitiveness or underconsumption domestically. So if you consume less domestically and you just export largely, so this will lead to a surplus for sure. So current account deficit is closely monitored by RBI or the central bank of the country, the policy makers basically. Because imbalances can lead to adjustments in exchange rates, impact forex reserves and influence economic policies. Note that in current account deficit, its excess imports are often financed through borrowings or using forex reserve itself. So current account deficit is somewhat tricky. If you see, as a result of higher consumer spending, whether that within that country itself due to larger population like in India and China, there can be a large internal consumption of GDP which is called final consumption. In China, it's around 53%, the internal consumption or else the final consumption. India is around 60%, but unlike China, whose share of global GDP is around 19%, India is around 10% only and US is around 13% if you consider the purchasing power parity GDP. If you consider the GDP in terms of purchasing power parity. Our finance minister predicted that from 10% of GDP contribution to the global economy, it will rise to around 18% in the next 5 years, and by 2031 will be double. It's around 20% GDP contribution will be from India is what is predicted by the finance minister. So what's this purchasing power parity? The GDP expressed in those terms. What is that? It is a measure of a country's economic output that accounts for differences in cost of living and inflation rates across the country, unlike nominal GDP, which uses current exchange rates to convert a country's economic output into US dollars or another currency. GDP PPP, which is the purchasing power parity, uses the concept of PPP to provide a more accurate comparison of living standards and real economic productivity between countries. PPP helps to compare the economic performance of different countries more accurately than with the nominal GDP. Countries like India with lower nominal GDP can rank higher when measured by GDP PPP because of the lower price levels in these countries. So as I told, the final consumption, otherwise called the internal consumption within the country, is 60% of GDP contribution in India. So if you see, around 20-22% is only the exports for the India. If there is a dip in the exports also because of the strong internal consumption, because of the large population, 142 billion population, our GDP is not much impacted. So this is the advantage of the higher population and its large consumption, which contributes to the GDP of the country. If you see, GDP is split into various components based on expenditure approach. So on the screen you can see, based on the expenditure breakup for GDP, one is consumption, which I told is 60% of the GDP. So this can be private final consumption and government final consumption. Both this contributes to 60%. Then comes the investment, otherwise called the gross fixed capital. So this is around 30% of the GDP. And next comes government spending, otherwise called the government expenditure. This is around 10% of the GDP contribution. And rest 5% is the net exports. So that's like minus 5%. Net exports is nothing but total exports minus the imports. Also the GDP breakup can be by sector. So sector wise, if you see, agriculture is the primary sector, industry is the secondary sector, and services is the tertiary sector. So agriculture is around 15% of GDP, industrial contribution is something around 30% of GDP, and services is the largest, which is around 55% of the GDP. 55% of the GDP contribution is from the services, which includes your IT services, healthcare, etc. Agriculture, if you see, almost more than 40% of the population is working in agriculture, but their GDP contribution is just 15%. So if you see, GDP on PPP basis is important to measure the standard of living within a country, its economic comparisons and global rankings. This provides a more realistic comparison of economic productivity and living standards between countries by adjusting for price level differences. So earlier we were speaking about the primary sector, secondary sector and the tertiary sector, which is the breakup of GDP by sector. So in that I told that agriculture is the primary sector. So agriculture also includes forestry, fishing, mining and quarrying. And the secondary sector is like manufacturing, construction, utilities. Utilities include production and distribution of electricity, water and gas, etc. And the tertiary sector includes services, which can be retail, finance, education, healthcare, IT, transportation and tourism, etc. So the GDP, total GDP in terms of sector is like primary, secondary and tertiary, all three added up, you will get the total GDP. Now let's again detail out on what I told as gross capital formation. So GCF is a key economic indicator that measures the total amount of capital invested in the economy for the production of goods and services over a year. This is a crucial factor in determining the future production capacity of a country. So the components of gross capital formation, GCF, are three: gross fixed capital formation, changes in inventory, and third one is net acquisition of valuables. So gross fixed capital formation is the largest of the GCF three components, which includes investments in long-term physical assets like buildings, machinery, infra and equipment. Second is changes in inventory. So the net change in stock of goods held by businesses is nothing but the change in inventory. So this includes raw materials, work in progress and finished goods. This indicates that businesses are producing more than they are selling. Hence, it's stacking up in the inventory. Now the third one is net acquisition of valuables, which includes non-financial assets like precious metals, jewelry, art and antiques. They don't contribute directly to the production. They are considered a form of capital as they hold some value and can be sold in future. Now let's get back to GDP. There are two types of GDP growth. One is real GDP. So the real GDP measures the total value of goods and services produced in a country within a given period, but adjusted for inflation or deflation. It reflects the value of goods and services at constant prices using a base year to remove the effects of price changes. But if you see in nominal GDP, it measures the total value of goods and services produced in a country within a given period, usually a year, at current market prices only. It does not adjust for inflation or deflation, meaning it reflects the price levels of goods and services at the time of measurement. So hope that clarifies the difference between real GDP and the nominal GDP. Now let's talk about fiscal policy. So government brings in fiscal policies to control economic growth and inflation. Fiscal policies are government policies related to taxation, spending and borrowing that influence economic conditions. It includes measures like government spending and tax policies to control economic growth and inflation. So now what is inflation? It is simply the measure of overall increase in the prices or increase in cost of living in a country over a period. So normally it's expressed on a yearly basis. So 100 rupees today is much valuable than 100 rupees in the next year due to inflation eating away or eroding away its value. It is simply the rate at which the prices of goods and services rises, eroding your purchasing power. So there are various types of inflation like food inflation, consumer price inflation, CPI. So consumer price inflation is the one which measures only selected consumer goods. Now another index is wholesale price index, WPI. In this type of inflation, it measures prices of goods sold in bulk or commodities traded between businesses rather than goods bought by consumers. Another one is producer price inflation, PPI. So PPI is a measure of the average change over time in the selling prices received by domestic producers for their output. This is an indicator for future CPI, the consumer price inflation. Now, as we have spoken about inflation, let's talk about deflation. Deflation, on the other hand, is the decrease in the general price level of goods and services, which can increase the real value of money but also lead to reduced spending and economic slowdown. Now that we know that we have to borrow to service the deficit, so banks play a major role here. Also various institutions. So how do government borrow money? They normally raise something called treasury bills or T-bills or government bonds, wherein they are bonds for raising a particular amount of money which will be paid back to the lenders over a period of time called the maturity period, with some interest rates called the coupon rates to attract the lenders. Logically also, if you think, the debt is used to nourish the GDP. So debt to GDP ratio is an important ratio which shall be below 80%, which shows an healthy, not over leveraged economy. So if you see currently as I speak, our debt to GDP is something around 82%. But if you see debt to GDP ratio of US is above 120%, which is highly overcooked. We have discussed in detail about US recession in our last video. So if you have not seen that, I strongly recommend you see that, wherein we have discussed in detail about the fiscal policies, monetary policy, recession and other macroeconomic fundamentals. You should note that the yearly interest rate for the debt taken forms a major percent of the overall expenditure of the government for India. It's 20% of the total spend. So over leverage leads to debt bubble and credit bubble, as explained in my US recession video. So to boost the GDP, government brings in various policies like the PLI and other yojanas or programs to boost the economic activity, to boost the GDP end of the day. Also, though tax is major income for government, they reduce tax like corporate tax to induce business activities, and in return benefits from volume play, just like a business which goes on a scale. Also, central bank, in our case RBI, brings in various monetary policies to support the economic growth and stability. Other than the bank reserve ratios, the central bank plays with the interest rates as well. Monetary policy is the process by which a central bank controls the money supply, interest rates and inflation to stabilize the economy. So what's the interest rates? It's the cost of borrowing money, usually expressed as a percentage. Central banks like RBI sets benchmark interest rates to influence economic activity. Also, you should know about supply and demand concept. It's a fundamental economic concept that describes the amount of a product or service available, which is the supply, and the desire of the buyers for it, which is the demand, which together determines its price. So supply and demand is very vital and very important in an economy. If the interest rates, which is a repo rate, is increased by the RBI, it makes the cost of borrowing high, which reduces the borrowing, because high interest rates means the people tend to borrow less. So this means less liquidity. So less productivity of goods and services, which means less demand, and then deflation. So less business activity, so there can be job cuts, and the economic slowdown may slip to recession as well. So recession is nothing but GDP reducing continuously for 2 consecutive quarters for a longer period. So we have detailed out much about recession in our last video. And conversely, if you see if this inflation is shooting up, the central bank comes up with the cut in interest rates. So they basically reduce the repo rates, which basically reduces the cost of borrowing, which induces easily available money. So more economic activity and more production. So businesses flourish and expand, which results in more job opportunities. So GDP shoots up because there is a lot of spending and there is a lot of taxation and there is a lot of economic activity and there is a lot of revenue for the government. So more revenue means they borrow less. So they borrow less means their interest payments also goes low, which again contributes much to revenue. So there can also be a case wherein there is a situation of stagflation as well. So regarding stagflation, already I have discussed very well in my earlier video, the link for which I am leaving in the above tab. Now another important concept in the Indian economy, well in that case any economy, is foreign exchange reserve, otherwise called forex reserve. So forex reserves are assets held by a country's central bank, here in our case RBI, and can include bank notes, bank deposits, T-bills and other government securities. Also there can be gold reserve and special drawing rights, otherwise called SDRs. These assets are nominated in foreign currencies such as the USD, Euro, Pound Sterling, Japanese Yen, INR and Swiss franc. This is as far as RBI is concerned. So now that you have understood very well about forex reserve, you must be thinking innocently that why can't RBI pay off the public debt, basically the government debt, from the forex reserve? Like if you see, the debt is around $664 billion as we speak and the forex reserve is around $675 billion. So both are almost the same. So why can't we just make the debt zero for the country by utilizing the forex reserve? So if you see, RBI prioritizes maintaining a robust level of forex reserves to ensure economic stability, support the rupee and act as a buffer in times of crisis rather than using to repay the debt. RBI uses forex reserve for currency stability. How it is bringing in currency stability? RBI sells dollar to prevent steep depreciation in the INR. Also it utilizes forex for economic security. So it's like a safety net while economic crisis. Then again it utilizes for liquidity for imports like oil, machinery and raw materials. Also it utilizes forex for investment returns, like RBI typically invests forex reserve in safe and liquid assets like foreign government bonds, which many a times gets returns exceeding some of the external debt of India. So if the interest rate of external debt of India is something, and if you are getting slightly higher returns on these bonds or T-bills, then it is better to keep the forex reserve with a higher return, and that can be utilized to repay the debts as well. And another thing is that they also utilizes this forex for debt management strategy. So basically interest rates from forex and signaling the market, because if a country is having a highest forex reserve, it's taken as a positive thing for the investor, building confidence in the investor about the economic stability of the country, and it helps bring in more investments from the foreign as well to the country. That's why they don't utilize forex to repay the debt. Now forex reserve as of August 16, 2024, as I told, it is 674.66, which is like $675 billion, out of which $591.57 billion is of foreign currency assets, FCA, which includes T-bills bought by foreign currency. Next one is gold reserve, which is around $60.1 billion. Special drawing rights is around $18.34 billion, and the remaining is IMF reserve, which is around $4.65 billion. IMF is International Monetary Fund.
So as I told, current account deficit is paid off using the country's forex reserve. So current account deficit, if increasing, then the forex reserves keeps decreasing. So the classic example is the balance of payment crisis in 1990-91 for India, while the first Gulf War, when crude oil prices shot up along with the dissolution of the Soviet Union. Then our current account deficit had increased so much and we had to pay it off using our forex reserve. It had fallen so much to a lowest level of only 2 weeks of catering to the trade needs, wherein currently as I speak, this is around 11 months, which is decently high. If you see crude oil, coal and natural gas imports increases our current account deficit, and government is really putting genuine efforts to bring down current account deficit by reducing dependence of energy intensive imports like this crude oil by promoting renewable energy and larger percentage of ethanol blending. So currently it is 15 to 20%, which will be further increased to 30% soon. Also, the domestic Indian coal usage is being promoted. Though the ash content is low and the GCV is very low, it is actually substituting many of the imported coal requirements for various power plants in India. Also, excessive import of gold adds on to our current account deficit. Due to Indian population sentiment on gold usage as ornaments has really made it a tough issue for government to cut off the gold imports. Though the sovereign gold bond has helped government to attract gold investors and cut off gold imports. At the end of the day, if you keep on cutting the imports and increase the exports, so this will actually cut down our current account deficit towards a journey to current account surplus. So edible oil imports is another issue. The agricultural boost by fixing the MSP, minimum selling price, and the deep R&D added by some subsidiaries will really help reduce the imports of edible oil, and this will improvise the domestic production of it, thus cutting the imports of edible oil. Another is electronic imports like mobile phones. So the PLI schemes by government also has brought in big companies like Apple, Foxconn and other players to India for producing iPhone and other semiconductor or electronic based products in India. Government has also come up with a special Vostro account wherein the foreign traders will do trades in INR and not in dollar, which will also improvise our current account deficit. So this is as a part of government's rupee internationalization. So R&D spending in India is very low, much below 1% compared to global peers. This added by lack of enough human capital, as I explained earlier, has led to India missing the major industrial evolution. So our manufacturing contribution to GDP is only, as I told, 11%. So this is much higher in developed countries like China. So this manufacturing industry has to expand a lot because manufacturing industries will employ loads of employees, unlike service intensive businesses, because in manufacturing it will trickle down to the lowest person in the population, starting from labor force and up to a CEO level, unlike services wherein it is highly qualified people who are catering to the business. So this will not create much of a employment, though GDP contribution will be higher. Another issue is that due to high inflation worldwide, though India is well within control, the foreign central banks, including Fed, has raised the interest rates, leading to global investors investing in these safe countries like in their T-bills and bonds, and not in risky developing countries like India. So again, this capital outflow leads to increase in current account deficit.
Now let's further elaborate on debt. India's national debt, also known as public debt, consists of both internal, which is domestic, and external, which is foreign liabilities that the government needs to repay. So debts are of two types, as I told, domestic debt and external debt. So domestic debt includes government securities, T-bills and market borrowings. So government securities are bonds by governments, which is the largest component of the debt, and T-bills are like short-term investments in short-term bonds. And also market borrowings is like fund raised through sale of government securities in open market. Now external debt is again having various components. One is multilateral loans, another is bilateral loans, then commercial loans, export credit, and then non-resident Indian deposits. So multilateral loans is loans from international financial institutions like World Bank, IMF and ADB. And bilateral loans are loans from countries and other financial institutions. Commercial loans are loans from foreign banks and other financial institutions. And export credit is financing for import-export activities. Now the non-resident NRI deposits is like fund deposited by NRIs in the Indian banks. This is actually considered as a part of external debt. Now let's talk about remittance. It's the money sent or transferred from one individual or entity to another, often across borders. So individuals like say an Indian employee sending money from UAE who is working in UAE to family members or friends in India is considered as a remittance. This also adds to the forex reserve. Now government brings in various strategies to simulate the economy. So these are of three types: fiscal responsibility and budget management, monetary policy and economic reforms. So fiscal responsibility and budget management is like FRBM. So they bring in laws to limit fiscal deficit and external debt levels. Monetary policy is actually done by RBI. So RBI works to keep inflation under control and ensures borrowing costs remain manageable by interest rate and other reserve ratio modifications. Next comes the economic reforms. So government focuses on reforms to boost revenue, reduce wasteful expenditure and promote economic growth, which helps manage the debt burden. Now let's talk about budget. So what's a budget? So Indian budget, also known as Union Budget, is a annual financial statement presented by the government of India. So budget includes economic planning and policy implementation. So policy implementations include new tax policies, subsidiaries, economic reforms, etc. Budget also includes public accountability and investor confidence. So in the budget, it outlines government's expected revenues, expenditure for upcoming fiscal year. So normally it's from April to March. Budget is really critical for economic planning and policy making, reflecting government's financial priorities and strategies. Budget's key components include revenue budget and capital budget. So revenue budget includes revenue receipts and revenue expenditure, and capital budget includes capital receipts and capital expenditure. So on the screen you can see the complete budget at a glance document wherein all these things are reflected. Now let's talk about deficits in the budget. So on the screen again you can see that. So what are the deficits? Fiscal deficit, revenue deficit, primary deficit. These are the three types of deficits in the budget. Fiscal deficit, as you already know, is the difference between total expenditure minus total revenue. So this excludes borrowing, basically the debt. And revenue deficit is nothing but the difference between the revenue expenditure and the revenue receipts. So revenue deficit essentially indicates that the government is not generating enough revenue to cover its day-to-day expenses. Now comes the primary deficit. So primary deficit is nothing but the difference between the fiscal deficit and the interest payments. Now there is a way by which the finance minister presents the budget. So budget presentation process includes preparation, presentation, and later on a debate and approval. If you see, Indian economy operates as a mixed economy containing elements of both capitalism like US and socialism like China. A mixed economy accepts private property and permits economic freedom in the use of capital like a capitalist economy, but also allows government to interfere in economic activities in order to achieve social aims like a socialist economy. Now we already explained about the economic sectors, which include primary sector, secondary sector, and the tertiary sector. Primary includes agriculture, mining, forestry. Secondary includes manufacturing, industrial sectors, steel, automotive, production, etc. Then tertiary includes the services like rental, banking, IT services, education, healthcare. And tertiary sector, which is the services wing, is the largest sector contributing to GDP in India.
Now let's talk about government role. So government roles include policy making, various regulations, and public services. So policy making, already you know, this is done by the ministries, various ministries and the other departments. So this includes labor market policy, support to business while economic downturns, etc. So regulations is like bringing in various laws and regulations related to trades, transactions, labor and environment protection. One such regulation can be tariffs. So tariffs are taxes imposed on imported goods and services used to protect domestic industries from foreign competition or to generate revenue. For example, for Chinese imports, government has been imposing lot of dumping duty so that the Indian domestic producers, whatever they produce, are purchased or bought by the Indian population, or otherwise called the domestic consumption. And we have explained about this final consumption in that. So if that is done, then the GDP of China will not be nourished by the domestic consumption, but in turn it will nourish the Indian GDP. So tariffs are very important. Another thing is subsidy. Subsidies are government incentives and financial aid given to businesses, industries or individuals to support economic and social policies. Lot of subsidies are in place by the government, Indian government also, to boost our economic activity and to facilitate various businesses and trades so that our economy improves. Now let's talk about fiscal policy. So fiscal policy already we have touched upon in our session. So this includes budget. Then in budget you already know capex, then tax cut, etc. are discussed. So this budget also is funded through tax and public expenditure. Fiscal policy also includes debt management, and these policies are brought in place by funding through taxation, which are again dependent on the public expenditure. Now let's talk about monetary policy. So RBI brings in monetary policy. These are like the RBI regulates the money supply, interest rates and inflation. So the tools which they use for bringing in these regulations are like altering the repo rates, reverse repo rate, open market operations to control the monetary conditions. So open market operations can be money printing through buying back the bonds, or maybe controlling the money liquidity in the market by coming up with bonds. So these all things are operations which are done by the central bank of the country, here in our case RBI. So this also I have detailed it out in our earlier videos. Now let's talk about trade and investment. Exports and imports. These are basically as far as the trade of India is concerned. So this is very important and vital for the economy. In addition to that, investments are like foreign investment. So this includes FDI, FPI, etc. So this also we'll detail out soon. Now another thing is economic reforms. So we are very well versed about the liberalization of Indian economy since 1990 by cancelling out the license Raj and all, wherein the country was open for foreign investments, which has boosted the economy much ahead. Such economic reforms are very much important and has to be in place. Obviously, we are having a lot of challenges, and also there are opportunities as well. So opportunities is like India has got a very young generation. 50% of the generation is below 35 age, wherein we are not like old age population like Japan or even other countries. So we have got a good young population ready to work. Only thing, if we are giving in proper human capital, then this will actually push the economy up. We'll be talking about human capital, not to worry. Now also, if you see, the young population is one thing, and technological advancement and hard working middle class is another important factor which actually helps our economy to progress at a faster rate. Now instead of speaking about the positive things, let me speak about the challenges. So inequality is one main thing, the inequality between men and women. So here if you see, majority of the women are not working, men is only working. So women has got tremendous potential, but because of various reasons they are not able to work. Because of this, if you see India's population of 142 billion, which has recently exceeded China as well. We are having the largest population, but out of which almost more than 50% is women. So if they are not working, it will really impact our GDP and also the GDP per capita. So to counter to that, we need to have women empowerment, which these days are very much in place. Even our companies, our industries are also having norms by the government, which is pushing up the population of women, which will positively contribute to the overall growth of our economy. Infrastructure is one thing. We are a developing economy, so we need a lot of capex for this. So once the capex cycle is done, once the infrastructure is in place, then we will be growing fast near to our target of becoming a developed economy by 2047 and even becoming the third largest economy, moving from current fifth largest by 2030. Maybe we may become the third largest economy by 2028 as well. It's a wait and watch scene. But if you see, infrastructure has got a lot of capex, capital intensity. So this spending also has to be funded through borrowings because we don't have enough revenue to cater to that. So again, this may increase our fiscal deficit going forward. AI, artificial intelligence, is also a kind of threat because it may create jobs for educated IT mob or related graduates as far as AI is concerned. But if you see, this AI is bound to cut many of the jobs which is done by the low level wages labor kind population. So this will create job cuts, though it creates new job opportunities. So this also need to be properly monitored and encashed by the government. The other thing, income inequality. So if you see, the top 5% only is contributing to the complete major income of Indian population, and the GDP contribution is also by this top 5 to 10%. Rest all, if you see, there is a lot of problems in the income inequality, the unequal distribution of income within people, which can affect social stability and economic growth. So this is something which the government should be concentrating on, and they are working on that, but it's a long way to go. Poverty, another issue in our economy. So the people who are poor basically are not contributing to the GDP because they don't have a work in place. So even though they are as a population participating in the per capita GDP, their productivity levels are very low or almost near to zero. So the GDP contribution is not there. So government has to put in a lot of policies in place to elevate the people from poverty and to an employment, so that they also positively contribute to the revenue of the government. The lack of education is also important here. If you see, the graduates are having lesser job compared to undergraduates, wherein highly skilled people don't get a job because probably because of the education system or unavailability of the jobs because there are a lot of graduates graduating out of the institution, but the number of jobs available and the skill sets required for that job is very high, and they are unable to get a job. Wherein if you see a lower level grade wherein the education is not much, but the labor requirement is there and they are getting employed. This is another thing which we have to look at the education system. Now the final one is lack of human capital. So what is human capital? So everywhere you can see people talking about human capital, and India lacks that. That's what they are telling. So let us have a fact check. So human capital refers to the economic value of a worker's experience and skills. Human capital includes assets like education, training, intelligence, skills, health, and other things employers value, such as loyalty and punctuality, which are actually an intangible asset or quality that is not listed on a company's balance sheet, but which is required by the or desirable by the hiring agency or the company. So human capital will increase productivity and thus profitability. There is a strong relationship between human capital and economic growth, as it can boost the economy, because people comes with diverse set of skills and knowledge, which can positively contribute to the economic productivity. So governments who knows this provides higher education at little or no cost, as they get a complete payback, which is like return on investment later when these people start working and draw salary and pay tax and contribute directly to the taxes by becoming highly productive. So if you don't have a human capital, then the person becomes unproductive. So if productivity is not there, then there is no revenue from that person. So end of the day, government will have to borrow to uplift that person. Since the work done with higher education will often draw larger salary, which means they can spend more, again contributing positively to the revenue for the government. Also, a human capital can depreciate over a period. The most common ways of human capital depreciation are through unemployment, injury, mental decline, or inability to keep up with the innovation. For an example, if an employee has a specialized skill, if he lost his job and have a long break and couldn't keep up with these levels of specialization, then he may no longer be in demand when finally re-entering the workforce. So human capital allows economy to grow when the human capital increases in areas such as science, education, and management. It leads to increase in innovation, social well-being, equality, increased productivity, improved rates of participation, all of which contributes to the economic growth. When this increase in economic growth tend to improve the quality of the life for a population. So if you see, this increase in economic growth actually helps to improve the quality of life of the population. So human capital is of utmost importance, which the government is currently missing. I understand that there are a lot of priorities. They are concentrating more on infra capex and not on human capital, but infra capex just will not help. They will have to concentrate more on human capital as well, so that upskilling, empowering the people with education and healthcare will really uplift the productivity of the people in the Indian economy, and they starts contributing to the economy, hence reaching the target of $10 trillion GDP by 2030. So currency appreciation. If a country's currency is strong, imports become cheaper, encouraging higher consumption of foreign goods. However, this also makes exports more expensive for foreign buyers, potentially reducing export revenues and worsening the current account deficit. So that's why countries like China depreciates yuan, their currency, to reduce current account deficit by increasing the exports. In earlier years, India has also done similar strategy wherein INR was so much higher compared to US dollar. The INR value was at par with US dollar, but it was knowingly depreciated so that the exports are higher, so that the export trade for India nourishes, and this will eventually help our economy. So another thing is loss of competitiveness. So our reliance on imports for consumption, particularly if domestic industries are not competitive, can widen the deficit. A lack of competitive export industry makes it difficult to balance the current account. So this is also something which we should be looking at, so that we can improvise on this and increase our trades so that the economy further improves. Now another important topic to discuss here is the exchange rate. So this is the value of one currency in terms of another. For example, if you are talking about INR, Indian rupee, then its comparison with respect to US dollar. So exchange rates fluctuate based on economic conditions, interest rates, and market speculation. Now another topic which is at most important, foreign investment in India. So this plays a vital role in country's economic growth and development. So foreign investments in India is of various heads. One is foreign direct investment, FDI. Another is foreign portfolio investment, FPI, and other forms of foreign investments as well, which includes external commercial borrowing, ECB, FII, foreign institutional investors, venture capital, and private equity. So let's decode each of them quickly. So foreign direct investment, FDI, is like investments by foreign entity directly into business operations or infrastructure in India. This can be for establishing new businesses, acquiring existing businesses, or expanding operations in the country. So normally FDIs are of long-term investors. Unlike an FPI, foreign portfolio investors, this is highly regulated by SEBI, and this refers to foreign investors in Indian financial assets such as stocks, bonds, and mutual funds. Unlike FDI, FPI does not involve in direct internal or influence over the companies in which investments are made. It's short-term in nature compared to FDI, as I told. India is still an attractive destination for FPI because of its strong growth potential going forward. Now the third one, other forms of foreign investments, which we divided into external commercial borrowings, ECB, FII, and venture capital and private equity. So external commercial borrowings, ECB, these are like lendings from foreign lenders in foreign currency. FII is nothing but hedge funds, mutual funds, pension funds, and other investments in Indian securities. Even this includes investments in stocks as well. So these days you are hearing that FII has been selling a lot, and domestic institutional investors like the mutual funds and other inside institutions of India has been buying. So this keeps happening because of the geopolitical tensions and because of the higher interest rates by the US and foreign nationals. Because of this, the cost of capital is very high for them, and they find it safe haven to invest there instead of investing in developing countries like India. But if you see in September next month, Fed is going to probably cut the interest rates. In that case, we may have a large FI inflow wherein the interest rates are cut, so the cost of borrowing becomes cheaper for them, and probably they are waiting for that so that they can invest in India for having higher returns compared to the lower interest rates probably which they are going to have. Because of the inflationary pressures, foreign countries have been increasing their interest rates. So the higher interest rates have actually attracted the foreign investors to invest their money in those safe assets. But once that interest rates are cut because the inflation is easing, in that case, destinations like India can be good as far as stock market or other investments are concerned. Venture capital and private equity, those are investments in Indian startups and private companies. So these are also important as far as the foreign investments are concerned, because startup initiatives and new investments and in the private companies are important for growing the economy by contributing positively to the revenue for the government. So now the impact of foreign investments in India. It can be divided into 5 points: economic growth, technology transfer, infrastructure development, balance of payment, and finally job creation. Economic growth is by providing capital plus creating jobs and fostering innovation. These are things which will be in place if foreign investments are in place. Now technology transfer. So if you see FDI, often the foreign direct investments often brings advanced technology and expertise to India. So this will also enhance our technology and hence our productivity. This will help in improving the productivity and efficiency in Indian industries. Infrastructure development, very important. So helps in critical projects such as roads, airports, and energy plants. If you see the bullet train investments by Japanese government, all these things are typical cases of infrastructure development by foreign investments. Balance of payment, already you know, capital inflow by these foreign institutions helps improve the balance of payment, which offset the trade deficits. So this is also vital. At the end of the day, all these things, once capital is coming in, you are creating a lot of jobs, lot of business, lot of productivity, contributing to the GDP. Then all of this helps create job. Now challenges and consideration for foreign investments in India is again divided into 4. One is regulatory environment. So a lot of regulations, if they are in place, if they are not comfortable, the foreign institutions are not comfortable, they will not invest in India. Political stability is important here. Stable government. If the elections are coming, there is uncertainty that NDA or UPA is coming. So based on this, the foreign institutions will have their own take, and if political stability is not there, they won't invest. Global economic conditions is also important. Like as I told, interest rates, then geopolitical tensions like the Russia-Ukraine war or other wars. This can actually be risk for foreign institutions and they may shy away from investing in our country. Now, exchange rates. So exchange rate risk is another thing, the fourth one. So if you see currency fluctuations impacts the return of foreign investors. If the INR appreciates with respect to US dollar, then for the same US dollar, they can only invest smaller quantity. So that's why our currency depreciation is important, so that the foreign institutions comes in and invest here. Another thing is that government initiatives to attract foreign investments, much important. So again, I'll divide that into 4 points. One is their Make in India initiative. Second is Startup India. Third is PLI scheme. And fourth is ease of doing business reforms. So Make in India scheme is like flagship initiative aimed at making India a global manufacturing hub by encouraging domestic and foreign investments. So hats off to Indian government, wherein they have been putting lot of efforts for this Make in India initiative. And Startup India is another offering by which tax incentives are offered, simplifying regulations and providing financial support for the startup initiatives in India, so that again they become successful organizations or businesses contributing to the revenue and taxing and GDP contribution. Now, PLI schemes, production linked incentives, PLI scheme is an initiative by the government of India designed to boost domestic manufacturing and reduce reliance on imports by providing financial incentives to companies. These incentives are linked to incremental sales over base year of goods manufactured in India, promoting the production of specific products within the country. So this PLI scheme covers multiple sectors including electronics, pharmaceuticals, automobiles, telecommunications, textiles and food processing. Each sector has its own set of criteria and incentives tailored to its needs. So companies are rewarded based on their incremental sales or production growth. These incentives typically range from 4 to 6% of the sales value, though this can vary by sector. So the primary goals are to enhance India's manufacturing capabilities, attract foreign investment and create job opportunities, ultimately making India a global manufacturing hub, just like the Make in India initiative. So PLI scheme is usually spread over 5 to 7 years, allowing companies sufficient time to ramp up their production capacities and benefit from the incentives. The scheme is expected to generate significant investments in various sectors, boost export potential and help achieve self-reliance in critical areas. So this is PLI scheme has been really successful in India, whether it is the EV space or the lithium battery space, etc. Even the semiconductor space. So this PLI scheme has really played well for boosting the business and also positively contributing to the GDP of India. Ease of doing business reforms is by simplifying regulations, reducing excessive bureaucracy or adherence to official rules and formalities, and enhancing infrastructure. So all these things will really help a scenario wherein ease of doing business is promoted. Now let's talk about capital market, which is inclusive of the stock market. So they also play crucial role in functioning and growth of an economy. They serve as a platform for raising capital, allocating resources efficiently and facilitating investment and economic development. So capital market is a broad term that includes both stock market and bond market. It includes all financial markets when long-term debt or equity-based securities are bought and sold. So if you see with capital market or with the stock market, what happens? It actually helps mobilization of savings. So by offering various investment vehicles like stocks, bonds, mutual funds, encourages savings and helps in converting these savings into capital or businesses. Otherwise, you would be putting that money ideally in your bank accounts and as cash. So this will not actually help. So if you see, if you are putting that into work, so this will actually help the businesses, like the funding is given by us and the business is delivering good performance, and based on this performance the stock prices goes up and the one who has invested, which is like we investors, are rewarded as well. This also helps in long-term investments. Like if a stock to become a multi-bagger, we have to give some patient time. So the savings is going to that account, and even if you see mutual fund SIPs are also increasing these days. Almost a huge amount of money is flowing in the Indian market normally. That is why the domestic institutional investors, DII, is able to support the market by putting in all this money coming through SIP mutual fund SIPs into the various stocks and investments. Another thing is that efficient resource allocation. So financial stability, risk diversification, liquidity, all these things are part and parcel of capital market. The stock market helps in raising capital, as I told, wealth creation, and also corporate governance. If you see, if it was a private company, they need not declare their balance sheet or their annual report, or they don't have to conduct earnings call, etc. But if it is listed in the market, they are bound to declare everything as per SEBI rules, and as the promoters can be really transparent, and this transparency will lead to quality business being done by these organizations. Stock market, otherwise the capital market, also is a economic health indicator. The more amount of money coming into this really shows that the economy is doing well. Liquidity and market efficiency. Listing in stock market helps for a actual value discovery, price discovery of that stock. So unlisted shares will be always mispriced, as I always say. So a well functioning capital market supports long-term economic growth by ensuring that savings are effectively transferred into productive investments, while the stock market plays a critical role in wealth creation, corporate governance, and attracting foreign investments. So if you see Indian economy, or well, in that case, an economy is much complicated, but if you have understood everything which I have discussed in this video, be very clear that you have understood everything about an economic machine, how it works, what all revenue they get, what all expenditure they have to do, and for meeting that expenditure, how much borrowings they have to do, what is the deficit, what is the balance of trade, what is the fiscal policy, the gross domestic product, GDP, the forex reserve, then about recession, then about the debt or credit bubble, then the supply demand concept, interest rates, various types of debt, domestic, external, etc. Then the remittance, then the government strategies, then the budget, then the economic sectors which are involved in this, then what all government policies or regulations are in place to control the economic actions, then how the foreign investments are important here, and what are the challenges in the economy, and what all things are brought in place to counter these challenges. So if you have understood all of this, then I'm sure you are very clear on how an economy completely works from end to end. Now in this session, I hope I was able to explain you all these things. These are all the fundamentals of the economic machine. Now in the next session, I will be explaining in detail about our Indian economy with figures and graphs, with realistic values up to date, wherein you will have a further understanding about where our Indian economy is heading and how we will be sooner becoming a developed economy, a superpower in the world. And also equally, we will discuss about the challenges in becoming that superpower which we used to be in earlier times of our human civilization. So hope this session was really useful for you. See you in the next video with the exciting topic of Indian economy decoded. Till then, happy investing.